Hey everybody, this is Mike from Practical Income Investing. Today, I'm going to be talking about the 7 AI infrastructure stocks that I'm looking at, I'm watching, that aren't Nvidia. So everyone's talking about Nvidia and how, they are the number one AI story, and rightfully so, really. Biggest company in the world. But the AI build out is a lot bigger than just Nvidia. The AI infrastructure is a full chain. You have your cloud platforms, your chips, accelerators. You have high networking. You need electrical build out. You need power generation, memory, storage, cybersecurity is a big one. These are the companies that I'm looking at. So in this video, I'm not going to be giving you a buy list or anything like that. This is not about what to buy. This is going to be more like I'm going to be showing you 7 AI infrastructure stocks that I'm watching now. I'm researching right now. And I'm going to give you one from each of the 7 infrastructure sectors that I feel have the most potential and what I've been really watching and looking at. Some of them have gone, have been growing quite a bit lately, but all of these I'm looking at for more up to upside. My thesis is not broken on these. Um, I think we're in the early stages of this AI build out. I'm going to give you the reasons why. I'm going to show you what you're going to be able to. I'll show you what I see as far as what these companies mean, as far as my 7 fundamental principles. I have cards made up that you can pause. You can make copies of these if you like, and use them for your own research if you like. But I want to show you these 7 companies, what they're all about. So if you want to, again, you can uh, screenshot these cards as I go through them. I think they'll be a very helpful. What I'm going to do is I'm going to be going through catalysts. I'm going to show you some of the upsides and downsides to these because there's no such thing as no risk in the market. And you got to be ready for it. So without further ado, I'm going to get rid of my ugly mug and I'll go through these cards one by one and hopefully you can get some good information out of these. Again, it's not necessarily something I'm telling you to go buy out right now, but definitely worthwhile taking a look at. Even though a lot of these have ran, we're not even started yet. Let alone there may even be some stock splits in the future here coming up. So enjoy the video. We'll see you on the flip side.
Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. The first company is Alphabet, ticker GOOGL. Of course, this is Google. This is the hyperscaler and cloud platform layer. And the reason why I like Alphabet here is in this conversation this is because Google is not just one piece of the AI chain. It's like closer to the full stack AI infrastructure company. You have your Google Cloud, you have AI models like Gemini, you have custom TPU chips. They make their own chips. They're not relying on Nvidia or anybody else. You have your YouTube advertising, your Android, massive, massive data ecosystem that they have. And you have a huge core advertising business that really helps fund the long term AI build out. That matters because a lot of companies are spending heavily on AI, as you probably heard, but not all of them have the same financial engine underneath them. With Google, the advertising business gives a company like a very strong cash base while it continues investing in AI infrastructure, cloud growth, and custom silicon. So the numbers that caught my attention here are the revenue trend, the cloud growth, the operating margin, and their massive cash position. Um, I'm not going to read every single number on this slide, but it's exactly the kind of profile I like to study. Strong revenue, strong cash flow, real AI catalyst, and a business model that it's not dependent on one product or one customer. Now, the catalyst is the full stack AI opportunity: cloud, compute, TPUs, AI tools, and monetization across the whole Google economy or the ecosystem. The risk is that the AI capex is so expensive. So investors are going to keep asking whether all of this AI spending is going to turn into durable revenue growth and a stronger earnings power. So for me, Google is not a hyped up name or anything that's shiny. It's a core research candidate. So what I'm watching is Google's cloud growth, their AI monetization, their capex discipline, the margin trend, and whether the company can prove that their AI spending is going to produce a strong return. Next is Broadcom, ticker AVGO. This is the semiconductor and the custom accelerator layer. And this is one of the reasons why I wanted to do this beyond Nvidia video, because Broadcom is a major AI infrastructure name that it's not just a simple chip story. You know, Broadcom is tiered to custom silicon, AI accelerators, networking chips, infrastructure software, and AI hyperscaler spending. So if you want to pause the video here, take a screenshot of this profile. This is one of the more important ones because there's a lot of useful numbers on this slide. The numbers that matter to me are the total revenue, the semiconductor solution revenue, the AI semiconductor revenue, the adjusted EBITDA margin, and the non-GAAP EPS. So the catalyst is pretty clear. The hyperscalers are spending huge amounts of money on AI infrastructure, and they're just getting started, by the way. And some of what they want are custom chip designs around their own workloads. So this plays directly into Broadcom's strengths. Broadcom also has a high margin and strong cash generation, which makes it different from a lot of the speculative AI stocks. But the risk here is the valuation and the expectations. When a company is already recognized as an AI winner, investors can price in a lot of good news before the business even gets there. So I like Broadcom as a business, but I would not want to blindly chase this after any kind of a huge move. For me, this is a high quality watch list stock. And what I'm watching is the AI conductor revenue, the custom accelerator demand, both margins, and whether the stock gives a disciplined entry instead of just chasing the entry. I'm looking for a little bit of a pullback, and I think this thing can run. The third company I want to look at is Arista Networks, ticker ANET. This is the networking layer, and honestly, this might be one of the most overlooked prices or pieces of the AI infrastructure chain. AI data centers are not just about having the best chips. Those chips need to communicate with each other on massive scale at very high speeds with very low latency. And this is where networking becomes critical. Arista provides high performance cloud networking equipment and software for large data centers, cloud environments, the AI cluster enterprises, and campuses. Now, if you want to take a screenshot of this profile, is a good place because here's a good place to pause. This is a slide that shows revenue trend, growth margin, cash position, and a specific AI networking catalyst. So The numbers here that caught my attention are revenue growth margins, cash and investments, and the company's Q2 revenue guide. This is the kind of company that fits a lot of my 7 fundamental principles. You have the growth, you have a very strong moat, great management, strong margins, healthy balance sheet. Yes, by the way, I am invested in this company. I'll tell you right now. I have shares and leaps with this company. So the catalyst that I see is the AI Ethernet demand, especially as hyperscalers build large AI clusters and they need faster, more reliable networking. So the risk here is a customer concentration and valuation. A lot of the demand comes from the smaller number of very large customers. And if capex slows down or expectations get too high, the stock can be vulnerable. So for me, Arista is a high quality watch list name, but I am in it. I'm watching the AI network adoption. I'm looking at the 400G and the 800G switching demand, campus expansion, gross margin durability, and whether the stock gives me a better entry on a pullback. I'll be adding to this. The fourth company is Eaton, ticker symbol ETN. Now, this is the electrical infrastructure and power management layer. This is where the AI story starts moving away from just tech and into like real world infrastructure. Data centers need power distribution. They need the switchgear, the electrical system, the backup power, thermal management. They need all the equipment that's going to help the electricity move safely, efficiently, and reliably. This is where Eaton fits in. This is one of the reasons why I like Eaton for this video. It's not just an AI stock. It's actually tied to the data centers, the electrification, industrial infrastructure, really the reindustrialization, utilities, the power management. I mean, that makes it feel more practical and durable than some of just the more speculative AI names. So if you want to screenshot this slide, this would be a good time you can do that. This is the financial profile and the key metrics that show why Eaton is on my radar. The numbers stand out to me are the revenue growth, the segment margins, electric backlog orders, and free cash flow. The catalyst is the data center electrical demand, the continued backlog growth from broader power infrastructure cycle. The risk is the valuation and pressure and margin pressure. Investors have already started recognizing the AI data centers need a massive amount of electrical infrastructure. So the stock may already reflect some of that optimism. For me, Eaton's a high quality industrial infrastructure watch list stock. What I'm watching for is for data center orders, electrical backlogs, segment margins, free cash flow, and whether the stock gives me a better entry again on pullbacks. You're going to see a little bit of a theme here. Some of these stocks have taken a nice little ride, and what you look for are little pullbacks to dollar cost average into some of these names. Now, the fifth company, Constellation Energy, ticker CEG, this is power generation layer. At some point, the AI infrastructure conversation becomes very simple. Where is all of our electric going to come from? The AI data centers require reliable, around-the-clock power. That makes power generation, nuclear energy, grid reliability, long-term energy contracts more important. So Constellation is one of the most important clean and reliable power producers in the United States, and it has a major nuclear exposure. If you want to pause this screen here, you can take this slide. Here's what I'm going to be looking for. The numbers that stand out to me are the adjusted operating earnings, full year guidance, the nuclear production, the capacity factor, and the data center related power agreements. So the catalyst is rising demand for reliable power, especially from the large load customers like the data centers. The risk is that energy is not as simple as software or cloud. You've got regulation, you have power market volatility, project timelines, honestly, political risk, the nuclear fleet performance, and operating risk. So Constellation is not a stock that I would analyze like a software company. It needs to be viewed through a little bit of an energy market lens. So as an AI power demand becomes bigger, as a bigger topic, think of Constellation as it deserves a spot on this watch list. What I'm watching for is power contracts, nuclear fleet performance, regulatory developments, data center co-location deals, whether the rising demand turns into durable earnings growth. The sixth company is Micron, ticker MU. This is the memory and storage layer. And this is another part of the AI infrastructure chain that investors sometimes overlook. The AI workload needs massive amounts of memory and data movement. That includes DRAM, NAND, high bandwidth memory, the storage solutions that support the AI workloads and the data centers. So Micron is important because memory becomes more valuable when the AI models get larger, workloads get heavier, and the data centers need more bandwidth. So if you want to pause this, take a screenshot, this would be a good place to do it. The numbers that caught my eye, my attention here are really the revenue growth, growth margin expansion, operating income EPS, the free cash flow, and the growth in cloud memory and data center related demand. So this is a company where the growth profile looks very strong when the memory cycle is working in its favor. We also need to be careful here. Memory is typically cyclical. When the demand, pricing, and margins are improving, Micron can look great. But if the cycle turns, these stocks can fall hard. But what's a little bit different about now than before is that the data center build out is just massive. Now you have some new chips coming along on the horizon that you got to be. I'm watching as far as they're making things a little bit more efficient on the memory side, but so I'm looking at Microsoft the same way I look at. I'm looking at Micron the same way I'm looking at Alphabet or Eaton. Micron may have a lot more upside during this AI memory cycle, but it can be a little bit more volatile. The catalyst is the HBM demand, the AI server demand, the memory pricing, and the margin expansion. The risk is the cyclicality of it, the pricing pressure, capex intensity, and the possibility that investors kind of overpay at the top of this cycle. So what I'm watching for is the HBM demand, the gross margins, operating margins, the pricing trends, inventory levels, and whether the AI memory cycle stays strong. The seventh company is the Palo Alto Networks, ticker symbol PANW. Now this is the cybersecurity and the AI software layer. So as AI adoption grows, cybersecurity becomes more important, not less. The companies are adding AI tools, they're adding cloud networks, automation, agents, identifying or identity systems, and more connected infrastructure. So that can create a major productivity gains, but it's also expanding the attack surface. So Palo Alto Networks is one of those. They're one of the leading cybersecurity platforms in the market, and it's pushing deeper into AI-driven security, cloud security, the identity security, and the platformization. So if you want to take a screenshot of this slide, this would be a good time to do it. The numbers I care about here are the revenue growth, the next generation security ARR, the remaining performance obligations, the free cash flow, and the margin trends. The catalyst is continued cybersecurity spending, uh, enterprise AR adoption, cloud security demand, the growth in the next generation security ARR. The risk is valuation again, the competition, and the acquisition integration. So, a couple things I'll be looking for there. Cybersecurity is a strong long term theme. But it doesn't mean that every cybersecurity stock is a buy at any price. So for me, Palo Alto is a high quality watch list company. I'm watching the ARR growth, the revenue growth, free cash flow margin, the acquisition integration, and whether the stock gives me a better risk reward setup in the future here. So the final takeaway is simple. The AI infrastructure is bigger than any single company. It's a full chain. The cloud, chips, networking, electrical infrastructure, the power generation, memory and storage, cybersecurity. And these seven companies each represent a different layer of that chain. It doesn't mean I'm buying all seven today. I did mention I own a few of these, but it doesn't mean that every stock is cheap, and it definitely doesn't mean that there's no risk. Some of these companies are a bit expensive, some are cyclical, some are going to depend on the AI capex, some are perfectly are going to need perfect execution just to justify their valuation. But this is what I wanted to research is the major investing theme here, not by chasing the loudest stock on the social media, but by mapping the infrastructure chain, finding high quality companies, watching the numbers, understanding the risk, and waiting for attractive entries. That's the practical part. Build a watch list, do the research, watch the catalyst, respect the valuations, and let these companies prove it with results. If you found this helpful, you like the video, subscribe to the channel, turn on notifications. I really appreciate you guys. I'll keep building out more practical income investing research like this, focused on real businesses, real numbers, real risks, and long term opportunities. As always, this is educational only. This is not financial advice. So do your own research, know your own risk, and we'll see you in the next video.